This is Tony Girardic of Summit Property Management, and this is part 2 of what we're talking about today, which is assessing the purchase of multifamily apartment buildings. To this particular part of it, I'm just speaking about the mid-size, and that's 5 to approximately 30 units that you would be considering purchasing. Here, this is a little bit different than when we were looking at the very small 2 to 4 unit place, because number one, the purchase price absolutely plays a very important role in this. Every single point of change when you're looking at a building like this can actually translate into quite a significant amount of money, either from a month-on-month annualized basis or, quite honestly, from a cash flow or annual when you look at the return on investment over time. Let's talk about financing. Once you enter the realm of 5 units or above, you are no longer in the opportunity to be an owner-occupied property. You are now a commercial loan where you have to go through the commercial loan process, which ironically is a bit less tenuous than today's single-family up through a fourplex kind of world. But still, there are a lot of things you must consider. Number one, obviously, what is the purchase price? Number two, these banks or lenders, they start at no less than 20% down. Many of them require as much as 40% down for purchasing and using them. And for every dollar you put towards the down payment, they usually reward you with some form of a lower interest rate. So here you really must play the interest rate and understand what it means. How long is the duration of the note? A lot of the properties that you buy below 5 units have a 30-year amortized schedule. The note is for 30 years. Most of the time here, it's for 5 years. The note may come to maturity in 5 years, or it may readjust after 5 years. It just depends. You also are introduced into this new subject, depending on how big you go up, is the note recourse, non-recourse. Recourse means that I am buying the property and I personally am guaranteeing the payment of that. A non-recourse, which they usually will not do on a smaller property, i.e. 5 units, these are usually 30, 40, 50 units, means that you don't guarantee the note, the building guarantees the note, and if the building fails to pay, the building goes with the note, and you're off the hook. But with that comes higher origination fees and other considerations. The next component of this is as you go bigger into the multifamily space, the banks will look at you and or your team and want to know what is your experience in terms of owning / managing a multifamily property. If you come in with a completely green team, most likely the bank will hesitate to go near you unless you have a real reputable property management company associated with it, because you're increasing their risk. Furthermore, a bank won't lend on a vacant unit unless it's a construction loan where you're actually going through and you're repositioning the building. And again, that's with the experience. So you have to have a trailing history that goes with the building at purchase. And that's what's different, real different between the here and when you're buying a 1 to 4plex, because that's not an issue. Here, the annualized revenue of the buildings, what are the leases, what are the lease terms, what are the rates, what's the market rent, etc. Those play a much larger role in this. Your personal balance sheet. Again, yes, your personal balance sheet on a single family home or up to a 4plex is important. But here, your balance sheet plays a role combined with the value of the building, so that the lender will look at this very holistically. All of this goes into the financing of the building. Once you get past the financing, there's another component you've got to think about. Again, 1plex, 2plex, 3plex, 4plex. Usually you buy them in your name. When you start getting into the 5plex and above, now you have to consider things like legal entities. Let's say an LLC or a limited liability company. These are legal entities designed to protect you, the individual, or as they would call them, members, from any kind of liability. If somebody should fall down, get hurt, etc., it stays confined to the building. Or if something else happens outside of your world, at another building, they can't come after the building with the LLC. Gives you a firewall. Those things were legally designed to help you. You need to consider if this is a 1031 exchange, meaning you're swapping out from one property to another. You have very, very rigid and strict rules that go into those exchanges with timelines, how the money's handled, when it's handled, by whom is it handled. When you look at the strength of your legal documents, they call them articles of incorporation or the bylaws of the company. You can usually buy these online. You can go into Office Depot and get them pre-made, or LegalZoom, for example. I'm not going to say these are bad, but what I am going to say is that these documents require you to seriously think about not what's going to happen when it's good, but what are the bylaws and rules to deal with situations when they're bad. And I will tell you again, from personal experience, that if you have an LLC, no matter how much money you've paid for it by whatever lawyer, not everything is thought of. And so there are things that you've really got to consider when you look at an LLC document. Here we won't go into that, but those are serious considerations. Finally, I would also look at the insurance. Again, insurance is like programming a VCR. People don't understand insurance. There are many kinds of insurance. When you start buying buildings like this, you're looking at what is the insurance on, let's say, a 30-unit building. What's the deductible? No longer is it $1,000 or $2,000. Now you're looking at $5,000, $10,000, $15,000 deductibles. Do you have the cash to handle that? Also, certain lenders will require specific insurance riders or policies for things like your boiler system. So it's a separate policy outside of that. Again, more expense, but more consideration. The other is now you are viewed in the eyes of the tenants as you are the rich guy. So if they fall down the stairs, they're going to sue the LLC, the building, they'll go for you as well. You want to also look at what additional types of protection do you have. A good example would be a commercial liability umbrella policy. I would suggest if you're looking at this, speak to your insurance provider for more details on this. Finally, the last piece of this is around management. Here's where you have to do a real mental shift. When you've got a single house or up to a fourplex, you tend to look at buildings like this from the ground up. When you're going into a bigger property, now you have to start looking at things from top down. What does that mean? Basically, it means strategically. I don't care on a 30-unit building that I have a single vacancy. One vacancy is not going to fundamentally change the business model of the company. So that's why you're looking this way. I'm not worried about a $5 expense, whereas on a single-family home, I might be because I'm that close to the wire. Here, you start looking at what are my main expense lines and how are we managing this. You've got to have a budget to run a building like this. Again, because everything gets much more expensive. Know this. Buildings are living and breathing organizations. And people usually laugh when I say this. The building will take on the personality of the owner or the manager. So if you have an owner or a manager that is, let's use an example, they live for drama. I will tell you that the tenants will live for drama. You will have a very dramatic building, and everything will be a crisis. So consider that. That's not something you necessarily read about in a book or people will talk about, is the personality of the building. The other is one bad tenant in a building of 10, 12, 15 people, one bad tenant can start an uproar in a building. And you need to watch and look for those tenants. Who's the leader or who's the troublemaker? Sometimes there are none, but just one is all you need to disrupt a 20 or 30 unit building. Consider that. Beware of favoritism. You're now in a realm where everybody talks. Everybody knows each other in these buildings. And if you offer somebody a deal that somebody else doesn't get and they get mad, you have the potential to get into deep trouble. So if you don't have the knowledge of renting and lease law, etc., consider that. The final piece of this is the mystique of the on-site manager. personal preference. I have no time or use for an on-site manager. They're worthless. Is that a strong statement to make? Absolutely. But here's the other thing that nobody ever considers when they have an on-site, live on-site manager, is that there is a personal liability you assume because you have to have workman's comp insurance. You have to ensure that you're keeping track of their pay. You have a lot of things around labor law. And I will tell you, just from my own personal experience, that most on-site managers never fulfill the expectation you set in terms of the amount of work that you want out of them, no matter what kind of a manager they are. So consider those things as you move forward. There are many other things to consider as we go up and talk about multifamily, but let's stop with that for today. For more information on this or other topics, please visit us at echosummit.com/education. Thank you.